Nicole and Nat, thank you so much for joining us on the podcast today. I really appreciate you making the time.
Thank you for having us.
It's great. We're taking the act on the road, Jeff.
That's right. Well, Nicole, I wanted to start by just for the members of our audience who might not be as familiar with the National Bankers Association, kind of who you guys are and what you do, would love for you to give a little intro so everybody has a little context on that organization.
Well, great question. The National Bankers Association is a 95-year-old trade association that represents minority depository institutions, or MDIs. These are banks that are predominantly owned and operated by people of color, and they sit in and serve predominantly minority communities. So it's no surprise then that because they're owned and operated by people of color and they sit in and serve BIPOC communities, that they tend to be significant providers of mortgages and small business loans and access to financial services in these communities. Just a little bit of history. These are banks that were born out of racism because Black, Brown, and immigrant communities could not go to mainstream financial institutions for their banking services. And the first MDI was actually Freedmen's Bank in the 1800s.
And so, Association of MDIs, tell me a little bit about like what the organization at the NBA level, what are you guys focused on doing and how do you support those institutions?
So we focus on what I like to call the 4 Ps. Policy, so advocating for policies that serve minority banks in the communities that they serve. The second is providing programming to support them. The third is profile raising. So that is just raising awareness about our member banks and the sector at large. And the fourth is partnerships. We've spent a lot of time over the last 2 to 3 years around partnerships, creating partnerships with the public, the private, and the nonprofit sector to better capitalize, modernize, and strengthen our banks. So the 4 Ps is what we spend all of our time with here at the National Bankers Association.
I love it. You've got like an acronym for it.
Yes,
The 4 Ps.
it helps
like
me
I'm in
remember
marketing.
things.
I love mnemonics and numbers, and I tell my kids I like numbers in threes and never more than five because
There
more
you
than
go.
five.
It's too much. And I also think growing up in a church, a Baptist church, they like the preachers like their mnemonics. They like things that are memorable. Everything has to start with the same letter.
Yeah, 4 Ps. Excellent. I had one question for you, which is, I know all financial institutions are kind of going through the digital transformation, the kind of how do we meet consumers in particular and small businesses in the places that they're at now using the devices versus maybe the old branch centric model. And I know MDIs tend to be smaller than the larger, more mainstream traditional financial institutions. And I know that can make it more challenging in many ways to bridge that digital divide, to kind of get into that digital world. What are you seeing as the focus or how banks are tackling that challenge and that transition in the MDIs? Because I imagine it's a little different than what I might hear from a Chase or a Wells Fargo or a Citibank.
Yeah, you hit the nail on the head, right? Technology is driving everything and it's really transforming the banking landscape, but it is very cost prohibitive. And so one of the challenges that small community banks, when I think about my membership base, the average asset size is about $470 million. So the smallest of the small banks, they have a lot of challenges when it comes to leveraging technology because it isn't very affordable, right? Going on to the 3 Cs, it's cost prohibitive. They don't have the internal capacity to really manage technology in that way. They don't have dedicated IT staff. And the third is core integration. Many of them are reliant on their core providers. And so if their cores have outdated legacy systems or it's hard to plug in new technology, it's just not even worth the hassle for them. And so how are they managing these challenges? They're really trying to find good folks to partner with. They're not going to be able to build it or buy it fast enough. And so partnering with fintechs like Upstart to do some of the things that they're unable to do is really the only way that they're going to be able to compete. Because again, they're not going to be able to build it or buy it fast enough. So they're going to have to create partnerships in the areas that are really the most challenging for them. And some of those areas are around P2P. Everybody wants to do peer-to-peer, automated lending. And then the third is around online banking and just online onboarding, people wanting to open up and apply for a loan on their phone. Those are the 3 areas that they're really doubling down and trying to find great partnerships like Upstart.
I love it. And Nat, I promise we're going to get you in the conversation here too. So I might jump over to you. Nicole was talking about, being centered in and serving often underprivileged communities, and communities of color. And I know, you were part of launching the MoreThanFair initiative, which was really kind of trying to, I think, shift the way I think of it, the conversation from one just around fairness and certain technical measures of how we think about fairness It's one about inclusivity and how we actually make sure we're serving the communities that are most often left behind in the traditional financial service world. Can you tell me a little bit more about More Than Fair, why it was founded, and what the objectives of that are? Because I feel like they're aligned, but I'd love to get a little more detail on that.
Yeah, well, Nicole was a charter member with the NBA of More Than Fair, and so I think I'll just quickly back up and say, the partnership with the NBA for Upstart is really about inclusive credit. So, as you know, Jeff, like we tend to reach low and moderate income communities at roughly twice the rate of a traditional bank personal loan program at Upstart, and using a lot of alternative data for a reason, right? We're not using it for fun. It's not fun to process more data. It's because it really helps you find those borrowers that can repay who have been overlooked a lot. And so I think in our world, in personal loans and auto loans, Nicole mentioned mortgage credit, small business credit. In general, the sort of the other categories where Upstart has been strong in personal loans and auto loans have not always been the province of some of these smaller community-based institutions. And so there's really a natural partnership with Upstart and NBA, starting now probably a year and a half ago. And we have now three NBA, minority depository institutions and roughly 10 CDFIs total, I think. So there's a lot of partnership between Upstart and this kind of community that's growing. And More Than Fair was really an initiative that was both private sector, so the Upstarts and the National Bankers Association, the community lenders of the world, partnering with nonprofits to say, hey, look, we really need faster progress on racial equity when it comes to lending, on inclusive lending, on access to credit. We gotta move faster as a society, and the only way to do that is to kind of put everybody at the table. If government's not at the table, or the nonprofit, the civil rights groups and the consumer protection groups are not at the table, or private sector is not at the table, then you're going to be missing a really important viewpoint. So that's what More Than Fair is all about. We launched in September. We have headed towards a couple dozen members, and just a great community dialogue around how to move the policy framework forward and the technology forward to make this kind of lending make it lending more possible.
When you think about the policy framework, are there elements of that you feel like could be moved forward faster, or that are, somewhat more problematic in terms of making progress on racial equity and inclusion in terms of lending than others? It's, that's a
two big
phrase.
areas. Yeah, there's two big areas.
Yeah.
Two big
Nicole
areas.
had 4, and then she had 3, and Nat's got 2. So we're gonna have to. I
don't have a mnemonic device that I could think of, but there's two big ones. So the first one I would say is kind of in the Community Reinvestment Act, just really rewarding banks that have products that are responsive to low and moderate income communities. A lot of CRA has been, funding a real estate development project or some mortgage or some small business credit. But really, a lot of these communities need an affordable personal loan. They need affordable auto loans. They need to avoid payday loans. They need, sub 36% responsible credit. And so a lot of the banks have kind of never really participated. So we're urging that, more rewards for banks that really serve the needs of these communities. And then, so that's Community Reinvestment Act reform. And then I think the other big area is in supervision. Just when you think about fair lending law, there's a lot of questions about algorithms and fairness of algorithms. The problem is the existing algorithms and the existing lending are deeply unfair with credit scores and so forth. And so the way fair lending law should work is that supervisors should be asking the lenders that use these traditional systems, hey, have you looked at the possibility of being more inclusive by using an Upstart, model, or we're not the only one on the block as S model, whoever, like somebody who's trying to bring more data, better, math to this problem of credit to find more borrowers. They should really be getting those kind of questions. And I think instead you see this sort of the scrutiny in the white hot spotlight is generally always government kind of points it at something new. And so I think those are the two areas I would say: CRA reform and supervision focused on some of these new tools and making sure that the existing system is forced to kind of move a little bit faster.
I like it. We got 4, 3, 2. I mean, we have to get down to 1 here at the end. But Nicole,
we'll do it.
Nat mentioned you guys were a founding charter member of the More Than Fair Coalition. Yeah. Talk to me a little bit about why that was important to you guys to get involved. I don't know if it fits into one of your 4 Ps, maybe partnership or policies. Kind of in the middle of the two. But what was it about the what's going on there that you thought it was important to be involved?
Well, I think Nat really hit on it. It's about the who's at the table and what the focus is. The fact that you've got government, you've got civil rights organizations, you've got lenders, you've got technology folks, consumer advocates there. You've got the right people at the right table. And then what they're focused on is this idea of inclusivity, right? And how can we leverage data and how can we leverage technology to expand access to capital and credit and to become more inclusive? So I think the who and the what made it a no-brainer for us.
Mhm. You guys keep talking about this. It's one of these things I always have to remind people that like a credit system can work for financial institutions in terms of achieving certain loss rates while really not working for consumers or society in terms of making credit as accessible as it could and should be at similar loss rates. So an inaccurate system doesn't necessarily show up in unstable banks or excessive losses. It shows up in the consumers who often are not served despite being credit worthy if looked at in the right way, and are therefore left out of the opportunities that are often only unlocked by access to credit. Things like a car to get to a job, or the education you need to improve your skills, or those things that are really ultimately credit is how we fund opportunity and taking advantage of those opportunities in our society.
Yeah, well,
Absolutely.
I mean, it's kind of a no-brainer when you think, I mean, all of us, we live with credit scores every day. Credit scores are an important part of the system, but one three-digit number sort of being supposing to predict whether you can repay a $5,000 loan or a $500,000 mortgage, or just there's such different products. And so this one three-digit score that kind of takes all this data and tries to sort of pump out one predictive number is not really the way that we all should be looking at credit and thinking about credit. And so, the stat that really grabbed my attention, and, when I'm waking up every day, just really motivated to work on this issue set, 4/5 of black borrowers have a credit score under 700. I mean, when most banks are cutting off at 700, they're just writing huge potential applicant, minority communities out of their applicant pool. And so, not everybody is credit worthy. Not everybody can get approved for unsecured personal loans of $10,000 over the internet. But the people that can most benefit from these products often fall in that spectrum where they might not even be given a shot. And so I think fundamentally this idea of using more data, better AI tools to give those people a chance to apply. And some of what, Jeff, as you know, our small dollar product, seeing a lot of success because people who can't qualify for $8,000, if that's what they think they need, they're really finding that they could use $2,000, right? And that they will repay those loans, And so some of it is just having something that's out there that meets people where they are and what they need.
And I think kind of to build off of that, the reason why minority banks are able to say yes more than mainstream financial institutions when they're saying no has a lot to do with relationships, because we're not just relying on credit scores. We've got the relationship. So we're looking at other data points because we know that you're credit worthy when the data point says that you're not credit worthy or you're risky. And so the problem is, how do you scale that? And technology allows you to scale what a lot of these banks have been doing on a relationship basis, a one-on-one basis, saying yes to loans when others are saying no.
Yeah, I often get asked about alternative data, and people, there's often this lens that you're finding other ways to say no. And I just think that's fundamentally, you're finding other ways to say yes. Like maybe you don't have a great credit score, but there's something else I can see about you. And I think that's the thing people miss is it's really like there are lots of ways you can have demonstrated creditworthiness. I mean, for many that are younger to the credit system, just like you've never had a loan. Why have you never had a loan? Like that should be a sign of good financial fort. Like I never took out a credit card. I paid my rent. I paid on the debit card, and now I don't have credit. I never had credit, and like that should be a strong sign. But things like paying your cell phone bill and paying your rent, and those don't go up on credit files. And so finding other ways to look through data and go, hey, this person has demonstrated financial savviness. They've demonstrated responsibility in their financial lives. We should be giving them credit for that. I think it's very different than I think how people often go, you want to use this variable to cut off people that are going to be risky. No, we want to take the people who don't have other ways to show their creditworthiness and find ways to see it in their history, which can be done through relationships, to your point, Nicole, historically, or there's lots of ways data and technology can scale that. So that, because ultimately relationships don't scale that well
No,
in
they
terms of
don't.
cost
They
basis.
don't. You have to be high touch and high tech at the same time. Yeah.
Yeah,
You're
and Jeff,
full of like little
another
witty sayings, Nicole. I love it.
another company, there's a company in More Than Fair Coalition, Isuzu, that does the rent reporting work, and that's just like an example where 5 to 10 years ago, the idea of positive rental performance, and now all of a sudden they're, integrating with Fannie Mae and Freddie Mac, right? So the world is changing, and it's changing quickly. And the sort of, I think the whole idea of more than fair is, if the world's going to be changing quickly, we should have the right people at the table to just make sure that we're all in line with, hey, here's what's happening, here's where this helps, here's where this could create risk, and we're having a conversation with one another rather than kind of talking past each other. So I think it's really promising, and we have our next event coming up in another month here.
So now I'm going to ask you this: if organizations are interested in getting involved, and if people listening, so that sounds really interesting, I want to know more. Or how do I get involved? Where do they go? What do they do?
Yeah, so MoreThanFair.com. First, they take a poke through all the data. It really lays out some of the disparity in the existing credit system, the opportunity for AI to save American consumers. I think the number we came up with, Jeff, $100 billion annually in sort of excess, rents extracted through inaccurate models, if that makes sense. So there's this huge opportunity to make the world better that way. You can see some of the other members involved. Obviously, this is a community. And so, as a community, it's not necessarily open to those actors who might not be known for treating consumers well or trying to get people the lowest price. So it's definitely, intended to be, a community of people who are intentional about increasing access to affordable credit. That means, in general, in our world, sub 36% Military Lending Act compliant credit, and doing so in the small business space with responsible, practices around disclosure and so forth. So that's the industry side. And then obviously nonprofits that are trying to work in these communities every day are always welcome at the table. We need more of those, more voices who have worked on these different issues.
They're not new issues. Nicole, I wanted to ask you, I know I've read a lot about investments from, various institutions, often large banks, into the minority depository institution world, particularly over the last couple of years. I know the Biden-Harris administration recently announced the $8 billion investment into CDFIs, which are not MDIs, but are, often serving similar communities, which is helpful. What else do you think we should be doing to help support the institutions that are most directly serving these communities?
Yeah, so there's a lot of conversation around the capital that's coming in, and a lot of that capital has been focused on lending, right? So if we give these community lenders more capital, what are they going to do? They're going to push it out and lend it to the community at a time that they've been hit hard by the pandemic. And so in order to keep the economy going, let's get them lending. But I think the challenge is there's been so much focus on lending capital and not enough around how do you help them build their infrastructure, right? I've got all this capital. Now I need to push out huge amounts of it at scale. And the only way that I'm going to be able to do that is to update my infrastructure and to update my technology. And so I think that there's a lot to be said and done around how can we create partnerships to help them better build their infrastructure and to help them better increase their technology capabilities.
It's so true. When I came from the technology space into the lending space, and the most sure way to destroy value is to give people a lot of money and ask them to lend it without the infrastructure, because growing a lending business is exceptionally easy. Lots of people will line up to take the money. It's knowing properly who can pay it back. And that's both for the institution, but also for the people. It's easy to forget that when you make a loan that doesn't repay, you don't just lose your money, but that person, that community, that business is ultimately damaged by, having big credit on terms that they couldn't reasonably afford. And in the end, they end up damaging their credit and their future opportunities because of that. So that's certainly true. The infrastructure to do it right is a necessary investment.